Investing can seem overwhelming, but understanding the basics of stocks, bonds, and mutual funds is crucial for building wealth and securing your financial future. In understanding stocks, bonds, and mutual funds, the essentials, we break down these core investment options to help you make informed decisions. Stocks represent ownership in a company and offer the potential for high returns, but come with higher risks. Bonds are loans you give to a company or government, providing steady income with lower risk. Today we will talk about understanding stocks, bonds, and mutual funds, the essentials. So before we start, make sure to hit the like button and subscribe to my channel. What are stocks? Stocks, also known as equities or shares, represent ownership in a company. When you buy a stock, you are essentially purchasing a small piece of that company, making you a shareholder. As a shareholder, you have a claim to a portion of the company's assets and earnings, and your ownership stake is proportional to the number of shares you own. Stocks are bought and sold on stock exchanges, like the New York Stock Exchange, NYSE, or NASDAQ, and their prices fluctuate based on various factors, including the company's financial performance, economic conditions, and market sentiment. Types of stocks. There are two primary types of stocks: common stocks and preferred stocks. Common stocks. When people talk about stocks, they are usually referring to common stocks. Common stockholders have voting rights, allowing them to influence corporate decisions, such as electing the board of directors. However, common stockholders are last in line to receive any remaining assets if the company goes bankrupt. Common stocks have the potential for high returns, but come with higher volatility and risk. Preferred stocks. Preferred stocks provide a fixed dividend and have a higher claim on assets than common stocks, which means preferred shareholders are paid before common shareholders in the event of liquidation. However, preferred stockholders typically do not have voting rights. Preferred stocks are often seen as a hybrid between stocks and bonds, offering more stability than common stocks, but generally lower returns. How you make money from stocks. Investors can earn returns from stocks in two main ways: capital appreciation and dividends. Capital appreciation. This occurs when the price of a stock increases over time. If you buy a stock at $50 per share and later sell it at $80, you earn a profit of $30 per share. However, stock prices can also decrease, leading to potential losses. Dividends. Some companies distribute a portion of their profits to shareholders in the form of dividends. These payments are usually made quarterly and can provide a steady income stream. Not all companies pay dividends, especially those that are in a growth phase and prefer to reinvest earnings into the business. Risks of investing in stocks. Stocks can offer high returns, but they also come with significant risks. The stock market is inherently volatile, and prices can fluctuate dramatically over short periods. The risk of losing money is high, especially if you need to sell your stocks during a market downturn. Moreover, individual stocks are subject to company-specific risks, such as poor management decisions, financial distress, or industry downturns. Diversifying your investments across different sectors and companies is crucial to mitigating these risks. What are bonds? Bonds are debt instruments that allow investors to lend money to a corporation, government, or other entity in exchange for periodic interest payments and the return of the bond's face value at maturity. When you purchase a bond, you are essentially acting as a lender. Bonds are considered fixed income investments because they provide regular interest payments, known as coupon payments, at predetermined intervals. Bonds are generally viewed as safer investments compared to stocks, but they also offer lower potential returns. Types of bonds. There are several types of bonds, each with unique features and risk profiles. Government bonds. These are issued by national governments and are considered some of the safest investments, especially U.S. Treasury bonds. Treasury bonds, long-term. Treasury notes, medium-term, and Treasury bills, short-term, are examples. However, government bonds from emerging markets may carry higher risks. Municipal bonds, MUNIS. These are issued by state and local governments to fund public projects like schools, highways, or water systems. Municipal bonds can offer tax advantages, as the interest earned is often exempt from federal and sometimes state and local taxes. Corporate bonds. Issued by companies to raise capital, corporate bonds generally offer higher interest rates than government bonds because they come with a greater risk of default. The creditworthiness of the issuing company is a significant factor in the bond's risk level. High yield, junk bonds. These bonds are issued by companies with lower credit ratings and offer higher interest rates to compensate for the increased risk of default. High-yield bonds can be lucrative, but are far riskier compared to investment-grade corporate or government bonds. Capital gains. If you sell a bond before its maturity date and the market interest rates have fallen, the bond's price will be higher than when you bought it. You can profit from this difference. Conversely, if interest rates rise, the bond's price will decrease, leading to potential losses if sold before maturity. Risks of investing in bonds. While bonds are less risky than stocks, they are not risk-free. Key risks include interest rate risk. When interest rates rise, bond prices fall. This can be problematic if you need to sell your bond before maturity. Credit risk. If the issuer of the bond defaults, you may not receive the promised interest payments or the return of your principal. Corporate bonds, especially those with lower credit ratings, carry this risk. Inflation risk. If inflation rises, the purchasing power of the fixed interest payments diminishes, reducing the bond's real returns. Types of mutual funds. There are several types of mutual funds, each with a different focus and investment strategy. Equity mutual funds. These funds invest primarily in stocks. They can focus on specific sectors, market capitalizations, large cap, mid cap, small cap, or investment styles, growth versus value. Equity funds offer higher potential returns, but come with higher risks. Bond mutual funds. These funds invest in various bonds and are designed to provide regular income. They are generally less risky than equity funds, but also offer lower returns. Balanced or hybrid funds. These funds invest in a mix of stocks and bonds to provide a balance between growth and income. They are suitable for investors looking for moderate risk and returns. Index funds. These funds aim to replicate the performance of a specific market index, such as the S&P 500. They have lower fees compared to actively managed funds and are popular among investors who favor a passive investment approach. Money market funds. These invest in short-term, high-quality debt securities and are considered one of the safest investment options. They offer modest returns but high liquidity. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.